The story the financial media is not telling you is this: the collapse is not coming for the affordable housing market first. It is not starting in the starter home segment or the middle-class neighborhoods. The most alarming housing data in America right now is coming from the top. The luxury market, the segment of American real estate that was supposed to be insulated by wealth, by cash purchases, by the immunity that money provides, is experiencing something that data analysts are struggling to find the right words for. High-end home sales fell to their lowest level since at least 2013, according to Redfin's comprehensive 2025 Housing Year in Review published in January 2026. That is more than a decade of data. The worst year for luxury home sales in more than a decade. Pending sales of luxury homes fell 9% year-over-year in April 2025, the largest annual decline since August 2023, to the lowest level for any April since 2014. The month of April, traditionally the busiest buying season of the year, at a decade low. A Redfin premier agent in Portland, Oregon put it in language that every person watching this video needs to hear. Buyers looking at homes from $1–2 million up are almost non-existent right now. Even in nice areas, high-end homes are selling really slow. Almost non-existent. That is not analyst language. That is the ground-level truth of what is happening in the luxury market right now. And in the specific markets Discover the States will reveal today, the numbers behind that truth are more alarming than anything you will hear in a real estate forecast conference. Market number 1: Austin, Texas. Down 20% from peak and still falling. Austin's luxury market is not cooling, it is correcting, and the correction is the most severe of any major American metro in Redfin's national coverage. Here are the numbers, in sequence. Because the sequence matters. Austin's median home price peaked in 2022 at approximately $550,000 by May 2025, according to Austin-based real estate analytics firm Team Price. Real Estate's analysis of Mel's data. The median sold price had fallen to $450,000, a decline of approximately $100,000 or 2% from the peak. That is the most prolonged and substantial correction in more than 2 decades of Austin regional data. But that is the overall market. The luxury segment is where the data becomes genuinely alarming. According to Team Price Real Estate's percentile analysis of Austin's luxury market, the 90th percentile of Austin home prices, beginning at $1,792,500, has seen year-over-year prices fall 9.98%. The 80th percentile anchored at $1,049,990 fell 6.62% year-over-year. The steepest declines are concentrated at the very top. Austin's luxury segment is not following the broader market correction. It is leading it and accelerating past it. For luxury homes priced above $2 million in Austin, the figures reported for September 2025 are stark. Pending listings were down 65% year-over-year. Days on market reached approximately 111 days. Months of supply hit 1674, nearly 3 times the 6-month threshold that defines a balanced market. 16 months of inventory. In a city that was, 3 years ago, experiencing bidding wars on $3 million properties. The specific luxury properties tell the story most directly. A luxury home at 4808 Ranch Road 2022 underwent several price reductions over the prior year, a drop of nearly 30% below its initial April 2024 asking price of $350,000, according to Newsweek's February 2025 analysis. A nearby home dropped $1.75 million. Another fell $200,000. These are not isolated cases. According to real estate intelligence platform Parkle Labs, Austin is currently in what they classify as bear territory, with home prices more than 20% down from their peak. And they stated something that should stop every Austin luxury homeowner in their tracks. We still expect home prices to decline 16.5% from current levels over the next 12 months. This is the largest expected decline in our coverage universe of 40 real estate markets nationally. The largest expected decline of any major American real estate market, in Austin. And the luxury market is leading the way down. Market number 2: Cape Coral, Florida, America's worst housing market. The Wall Street Journal named it directly in June 2025. Cape Coral, Florida, America's worst housing market. The data behind that designation is specific and documented. Home prices in Cape Coral declined for 12 of the past 13 months before the journal's designation. 8% of homeowners in Cape Coral owe more than their properties are worth. Underwater mortgages at a rate higher than anywhere else in the country. According to Realtor.com's analysis, the typical single-family home in Cape Coral sold for nearly 7% less in August 2025 compared to the previous year. And compared to the pandemic boom era of August 2022, the median home sales price has dropped by over 13%. According to CultureMap Austin's analysis of Realtor.com, the Cape Coral-Fort Myers metro posted the second worst year-over-year decrease in median home values of any major metro in the entire United States in 2025 at 7.9%. Only Northport, Bradenton, Sarasota, also in Florida, ranked worse nationally. Cape Coral carries the third highest insurance premium to market ratio in the nation at 2%, meaning a $350,000 home costs $700 annually in insurance alone, before the mortgage, before the property taxes, before any maintenance. Adams Q3 2025 data confirmed Cape Coral as having one of the highest foreclosure rates among major American cities, and active listings in Cape Coral hit a record high in early 2025, 15,425 homes for sale, up 24.8% year-over-year, record inventory, falling prices, surging foreclosures, rising insurance costs that are making financing progressively harder to obtain. The luxury waterfront properties that drove Cape Coral's pandemic-era surge, the canal front homes, the direct access boating estates, are now sitting in a market where the buyer who valued them at peak prices has either left, is waiting, or has run the insurance and carrying cost numbers and chosen not to return. Market number 3, Northport, 20% below peak with more declines projected. Northport, in the Northport, Sarasota, Bradenton metro area, posted the single worst year-over-year decrease in median home values of any major American metro in 2025 at 8.6%, according to Realtor.com's analysis reported by CultureMap. The worst in the entire country, and the longer timeline is even more alarming. According to Realtor.com's data, Northport's typical home sales prices in August 2025 were 20% below where they were 3 years prior, at the August 2022 pandemic peak, 20% below peak in 3 years. According to Catality, formerly CoreLogic and one of the most authoritative housing analytics firms in America, Northport was flagged in their July 2025 Markets to Watch report as one of 5 American markets with the highest risk of further price decline. Every single market on that list was in Florida, and Northport ranked 3rd nationally for price decline risk. Catality's data showed a clear downward trend from Northport's 2022 peak, consistently lower each quarter, with the line heading into 2025 showing no stabilization. Active listings in Northport, Sarasota hit a record high 13,542 homes for sale, up 14.6% year-over-year. Condo prices specifically fell 8.9% year-over-year in Punta Gorda, the adjacent market in the same corridor. For luxury buyers who purchased at or near Northport's 2022 peak, believing they were entering a permanently elevated market, the 20% price erosion over 3 years represents a 6-figure loss on a single purchase decision, and the projections point toward continued downward pressure through mid-2026, with no credible bottom in sight yet. Market number 4, Naples, the luxury illusion. Naples tells a story that is more dangerous than a simple decline, because it is a market that has convinced itself it is immune from the forces destroying every surrounding market. Naples currently has the highest share of $1 million plus listings of any American market. Developers are rolling out $35 million beachfront villas and 12-unit boutique high-rises with private chefs, butlers, sommeliers, and dog walkers. Brokers speak about the billionaire buyers from New York and California with confidence. But underneath that narrative, the data is sending signals that every Naples luxury homeowner should read carefully. According to Worst Florida Housing Markets analysis of May 2025 data, Naples experienced a 14.5% decrease in median sale price year-over-year, 14.5%, in a market that describes itself as a world-stage luxury destination. Inventory in Naples grew 28.6% year-over-year to 7,932 active listings, with 731 of those, more than 1 in 3, having already received a price reduction from their original asking price. In Redfin's September 2025 national luxury data, Miami's luxury homes were taking under 30 days to sell, the slowest luxury market of any major American metro. West Palm Beach was at 115 days, Fort Lauderdale at 114 days. The entire South Florida luxury corridor, the one that was supposed to have absorbed permanent demand from New York and California migration, is now producing the slowest luxury sales times in the country. The Naples luxury story. is the story of a market that ran far ahead of its sustainable demand base during the pandemic migration wave, and is now discovering that the billionaires it attracted do not need to stay, and the aspirational buyers who followed them cannot afford what the billionaires drove prices to. Condo prices in Florida declined in 92% of the state's markets, according to Florida real estate data. Even Miami saw a 3.4% dip in condo values. In a luxury condo market where the unit purchased at $3 million is now worth $2.9 million while carrying $9,000 in annual insurance and $30,000 in HOA fees. The math of luxury Florida ownership is deteriorating faster than the marketing brochures acknowledge. Market number 5, Portland, Oregon, where million-dollar buyers have vanished. Portland's luxury market may be the most direct statement in American real estate right now about where the high-end buyer has gone. Meme Loggins, a Redfin premier agent in Portland, has become the most quoted luxury market professional in the country over the past year, because she keeps saying what no one else wants to say publicly. In April 2025, she told Redfin, buyers looking at homes from $1.2 million up are almost non-existent right now. Even in nice areas, high-end homes are selling really slow. If I have a buyer who finds the perfect house and is ready to make an offer, they tend to sleep on it for a little. And then they come back to me and say, nope, I think we'll wait and see if the price comes down. In August 2025, she updated her assessment. Luxury buyers are moving like molasses. They wait for $100,000 price drops and then negotiate over tiny issues like a leaking sink. The slow market is wearing sellers down too. I had a seller with a gorgeous $1 million home in a highly desirable area of Portland pull the listing from the market recently because she was exhausted from trying to keep it ready for showings for so long. Exhausted. A seller with a $1 million home in a desirable neighborhood who pulled the listing because the showing process wore her down without producing a buyer. Portland was one of only 2 major metros in Redfin's Q4 2025 national luxury analysis to record year-over-year price declines in luxury home values. Luxury sales in Portland are down more than 5% from a year ago. The $1.2 million buyer has not just slowed down. According to the agent working that market every day, they have effectively disappeared. Portland's luxury market is not a secondary story. It is the leading indicator of what happens when economic uncertainty, stock market volatility, and elevated carrying costs converge on the segment of the market that was supposed to be immune to all of them. Market number 6, the national picture, a decade low with no floor in sight. Every market we have discussed today is part of a national pattern that Redfin's 2025 year in review described in January 2026, with a sentence that should be the headline of every American financial news outlet. High-end home sales fell to their lowest level since at least 2013. That is not a single bad quarter. That is the accumulated result of a full calendar year, 2025, producing the worst luxury transaction volume in Redfin's recorded data. Lower than 2020, when the pandemic froze everything. Lower than 2018, when rates rose sharply. Lower than any year going back more than a decade. The data points that built that result. Luxury home sales fell to the lowest August level since 2013, the furthest back Redfin's records go. The typical luxury home took 64 days to go under contract in December 2025, the slowest December pace since 2020, and 5 days slower than a year before. Active luxury listings grew 5-6% year-over-year. Pending luxury home sales fell 1% in December, the steepest decline in 6 months. In April 2025, closed luxury home sales fell 5% year-over-year. Redfin senior economist Shahryar Bokhari stated it plainly. Last year was super slow in the luxury market, and this year is even slower. High-end buyers often keep the market moving because they're less tied to mortgage rates, often buy in cash, and can prioritize lifestyle over affordability. But right now, many of those buyers are waiting on the sidelines, holding out for more certainty around the economy and the housing market. Waiting on the sidelines. In the segment that was supposed to be immune to the wait and see psychology that afflicts rate-sensitive buyers. And the geographic spread of the collapse is expanding. According to Catality's December 2025 national housing analysis, at the start of 2025, only 6 major metros posted year-over-year price drops. By October 2025, that number had surged to 32, spreading beyond Florida into Texas, California, and the Mountain West. By October, a third of America's 100 largest metro areas saw prices decline compared to a year earlier. The luxury collapse is not contained. It is spreading. And it is spreading in the same direction that every major housing market correction has spread in American history, from the most overextended markets at the top, downward through the price tiers below them, until the correction finds a floor that the underlying economic fundamentals can actually support. Market number 7, the stock market connection. Why the wealthy are retreating. To understand the luxury housing collapse, you have to understand a connection that most housing market coverage misses entirely. Luxury buyers do not fund their purchases the way middle-class buyers do. They do not save for a down payment over years. They do not depend on mortgage qualification ratios in the same way. Instead, a large proportion of luxury buyers fund their purchases from liquid wealth, stock portfolios, investment accounts, business equity. When they decide to buy a $3 million home, the down payment, or the entire purchase price in cash, comes from a brokerage account. In April 2025, the stock market experienced significant volatility tied to tariff policy uncertainty under the Trump administration. The S&P 500 dropped sharply. Wealthy buyers who had been moving toward luxury purchases watched their liquid assets decline in real time, and Redfin's data captured the exact moment they stopped. Redfin senior economist Shahryar Bokhari explained the mechanism directly. Many luxury buyers are adopting a wait-and-see approach because of volatility across financial markets and shifting tariff policies. These high-end buyers often sell stock to help with down payments. But many pressed pause on their home search when the stock market tumbled in April. As a result, what is usually a fiercely competitive space is cooling. Pending luxury sales fell 9% in April 2025, the largest annual decline since August 2023, to the lowest April level since 2014. The month the stock market moved, the month luxury buyers stopped. This connection between equity markets and luxury real estate is the hidden transmission mechanism that mainstream housing analysis consistently underweights. When stock portfolios decline, luxury purchase capacity declines with them, not because wealthy buyers cannot afford their mortgages, but because the liquid assets they plan to deploy for purchases have shrunk. And in 2025, amid tariff volatility, economic uncertainty, and persistent questions about the direction of the broader economy, those buyers have done what every rational actor does when conditions become uncertain. They waited. Let's be honest. As we always are on this channel, the luxury housing market is not experiencing a 2008-style collapse that will wipe out decades of appreciation overnight. The total value of America's residential housing stock reached a record $48.6 trillion in Q2 2025 before pulling back slightly. The most desirable luxury properties, the ones that every serious buyer wants, are still moving quickly. There are specific luxury markets like West Palm Beach, Milwaukee, and Nashville where luxury prices rose 14% to 20% in 2025. Not every luxury market is in crisis, but the headline data from 2025 is undeniable and alarming. High-end home sales at their lowest level since 2013. Pending luxury sales at their lowest April level since 2014. Luxury buyers described as almost non-existent in Portland. Austin's 90th percentile prices down 98% year over year, with 74 months of inventory above $2 million. Cape Coral down 13% from 2022 peak, America's worst housing market. Northport down 20% from peak, the largest year-over-year median value decline of any major American metro in 2025. Naples with 6% more inventory and 1 in 3 listings carrying price reductions. Fort Worth and Portland posting luxury price declines in Q4 2025 data. And by October 2025, 32 of America's 100 largest metros posting year-over-year price drops, up from just 6 at the start of the year. The luxury market built its pandemic-era surge on a specific set of conditions: low rates, migration waves, remote work flexibility, stock market gains, and the collective decision by wealthy Americans to prioritize residential real estate above all other uses of their capital. Every one of those conditions has changed. Rates are not low. Migration waves have peaked and are reversing in some markets. Remote work flexibility has been curtailed by return to office mandates. Stock market volatility has made liquid assets uncertain. And the wealthy American buyer, the one who was supposed to keep the top of the market perpetually elevated, is sitting on the sidelines, waiting for the price that justifies the commitment. In the meantime, the data accumulates, the inventory rises, the days on market extend, and the sellers, who bought at peak prices with peak assumptions, are making the slow, reluctant discovery that the luxury market they purchased into was priced for conditions that no longer exist. Housing cycles do not end quietly. They leave lasting marks, and the marks being left across America's luxury housing market in 2025 and heading into 2026 are visible in every price reduction, every withdrawn listing, and every buyer who looked at a $3 million property, ran the numbers, and quietly decided to wait. Thank you for watching this in-depth report from Discover the States. If you found this analysis valuable, leave a comment with your perspective. Share this video to spread awareness, and make sure you are subscribed so you do not miss what comes next.